With nearly 75,000 crore of assets under management, HDFC Mid-Cap Opportunities is widely considered the king of the mid-cap funds. A 10,000 rupees monthly SIP started 10 years ago in this fund has grown to around 35 lakh rupees on a total investment of 12 lakh, delivering a solid 20.64% annualized returns. So what makes this fund stand out in a volatile category and consistently win investors' trust? That's exactly what we'll uncover in today's video. Hello and welcome to our channel 5-Minute Finance by ET Money, where we talk about the basics of investing and personal finance. In this video, we'll cover 3 key things you must know about HDFC Mid-Cap Opportunities Fund, especially if you are considering to invest in it. But before we begin, please note this fund is not our recommendation. Please do your own research before investing. So first, a little background and performance overview of the fund. HDFC Mid-Cap Opportunities Fund was launched in June 2007. Over the years, it has grown to become one of the largest and best performing mid-cap funds in India. In the last 5 years, the fund's AUM has nearly tripled from 25,000 crores in March 2021 to nearly 75,000 crores, making it a true heavyweight in the mid-cap fund category. This fund is managed by Chirag Setalvad, one of the most respected names in the mutual fund industry. He has been managing the fund right from the start and is known for his consistent and research-driven investment style. He is supported by Dhruv Muchal as co-fund manager. The fund's benchmark index is Nifty Mid-Cap 150 TRI. Now let's quickly look at how the fund has performed. So HDFC Mid-Cap Opportunities has performed better than both its benchmark and category over the past 3, 5 and 10 years. For instance, in the 3-year period, it has delivered 5 percentage points higher returns than the category average and 3 percentage points more than the benchmark. Now on your screen, you can see the rolling returns of the fund. Rolling returns help us assess a fund's performance consistency over different time frames. So instead of looking at just one fixed period like Jan 2020 to Jan 2025, we calculate returns for multiple overlapping periods, say 3-year returns calculated every day for the last 10 years. It helps to remove timing bias and gives a true picture of how reliable the fund's performance is. We'll look at 7-year rolling returns. Now, starting in January 2013, we checked how the fund performed if someone invested for 7 years. So, we first looked at the data between 1st January 2013 and 1st January 2020. Then between 2nd January 2013 and 2nd January 2020 and so on. The 7-year rolling return of the fund is 17.3% and has comfortably outperformed the benchmark and the category. This shows the fund has consistently generated better returns over the long term. However, the fund lagged behind the category as well as the index over a 5-year period. Of course, for mid-cap funds, it's very difficult to consistently beat the Nifty 150 mid-cap index. In fact, for a 7-year period, only 9 out of 22 qualified schemes managed to outperform the benchmark when we compared their rolling returns. And HDFC Mid-Cap Opportunity was one of them. So next, we'll check the fund's downside protection risk, a key differentiator in any fund's long-term success. For any fund to be successful and consistently generate better returns, it has to manage downside protection risk, meaning how well the fund can protect your money during market corrections or crashes. It's not just about delivering higher returns in a bull market. It's also about how less it falls when the market goes down. If a fund can limit the losses in falling markets and still participate well in rising ones, it creates a compounding edge over time. And this is where HDFC Mid-Cap Opportunities Fund has stood out. On the screen, you can see quarterly returns of the Nifty Mid-Cap 150 index since June 2013. Now, in 8 quarters out of 47 quarters, the index has declined by more than 5%. In all these 8 quarters, the fund has performed better than its benchmark, not by big margins though. You can see in the March 2020 quarter, when the index crashed by 28.6%, the fund declined by 27%. In the recent drawdown in December 2024 quarter, when the Nifty Mid-Cap Index declined by 5.18%, the fund value dropped by just 1.92%. Next, Let's look at where it's actually investing your money, the portfolio strategy and stock selection. As per SEBI's mandate, any mid-cap fund must invest at least 65% of its assets in mid-cap stocks. The remaining 35% can go into other categories like large, small, or even debt. Now, as you can see on your screen, what's interesting here is the fund's small cap exposure, which has ranged between 15% and 20%, while its large cap allocation has stayed between 5 and 10%. But here's what stands out. Over the past year, the fund has reduced its large cap exposure and increased allocation to small caps. This shift likely reflects the fund manager's view that small caps currently offer better value after the correction and stronger growth potential. It also shows how actively the fund adjusts its positions based on market valuations, aiming to improve return potential. Next, let's dig deeper to understand the portfolio style better. So let's look at the portfolio turnover ratio of the fund. This number tells us how frequently the fund manager is buying and selling stocks within the portfolio. Now, in case of HDFC Mid-Cap Opportunities Fund, the turnover ratio has generally been low, below 20. This means the fund's portfolio is not churned frequently. Less than 20% of the stocks in the portfolio have been changed in a year. This reflects a high conviction, long-term approach where the fund manager prefers to stay invested in quality businesses rather than constantly reshuffling the portfolio. It holds 55 stocks in its portfolio and looks well diversified, with top allocation to auto and banking stocks like Max Financial Services, Federal Bank, and Balakrishna Industries. The top 10 holdings of the fund are on your screen. So to sum it up, HDFC Mid-Cap Opportunities fared better than the category and the benchmark in the long term, while it underperformed in the medium-term period of 5 years. It managed to cushion the downfall vis-a-vis its benchmark and the category well and follows a stable investment approach under Chirag Sitalwad. But remember, past performance does not guarantee future returns. So before investing, always assess your goals and do your own research.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.